All right, welcome back to the Daily Market Narrative for 14th August, your favorite spot to untangle the financial spaghetti of the day with me, Dave. Today, we're diving deep into the narrative that's got Wall Street buzzing like a beehive after a sugar rush, the soft landing dream. It's the story everyone wants to believe, the economic fairy tale where inflation just politely cools off, the economy avoids a nasty recession, and the Federal Reserve, like a benevolent wizard, starts showering us with interest rate cuts later this year. Now, if you're buying into this soft landing narrative, the bull case is pretty straightforward, right? You're envisioning a Goldilocks economy, not too hot, not too cold. Inflation continues its graceful descent without crushing economic growth, especially that stubbornly strong labor market. This perfect scenario gives the Fed ample cover to start easing up on rates, maybe even giving us a nice pivot, as the market loves to call it, perhaps even a 50 basis point cut in September if some folks get their way. And why does this matter? Because with lower rates, investors can justify paying higher prices for stocks, anticipating corporate earnings to remain surprisingly resilient even as disinflation takes hold. It's like the market is throwing a party and the invitation says, "Fed cuts coming." But hold on a second. While the soft landing narrative is certainly the prevailing sentiment, let's not get too cozy in this economic hammock. Because every good story has a twist, or at least a potential pothole. What if inflation decides to be less polite and re-accelerates, forcing the Fed to keep rates higher for longer, or even, gasp, raise them again? What if that resilient labor market suddenly decides to take a nap? Or what if corporate earnings, despite the optimism, finally feel the pinch of cumulative rate hikes that have been in place for a while? The market is pricing in a lot of perfection, and as we all know, perfection in financial markets tends to be about as common as a unicorn riding a skateboard. If any of those what-ifs start to materialize, this soft landing could quickly turn into a rather bumpy ride, or even a hard one, catching a lot of optimists off guard. Speaking of bumpy rides, let's talk about the squiggly lines that dictate trillions of dollars. Welcome to our technical check-in. The long-term chart for the SPY is still looking very, very bullish, which is great if you're into that sort of thing. And now, with the latest new high breakout, even the daily chart is flashing green as long as the SPY remains above its key support level of 640. That's your floor, folks. If we hold that, it will be grind up to the next big resistance point, where all the sellers might be hanging out, is way up at 664. Now, for the headlines that matter, because what's a market narrative without a little breaking news? First up, this juicy one from CNBC. Trump considering 11 candidates for Fed chair, including David Zervos and Rick Ryder, sources say. So, President Trump is already reportedly lining up potential replacements for Jerome Powell when his term ends in 2026. Names like Jefferies' David Zervos, Larry Lindsey, and BlackRock's Rick Ryder are apparently on the list. The market impact here is pretty clear. It introduces uncertainty. A new Fed chair could mean a completely different approach to interest rates, inflation, and monetary policy. This could lead to some volatility as investors try to figure out what a new captain at the Fed helm might mean for the economy and their portfolios. Next, a headline from Bloomberg that sums up the current mood. Stocks and bonds climb on September Fed cut wagers, markets wrap. Global markets are basically high-fiving each other, betting heavily on the Fed cutting rates as early as September, with some even whispering about a hefty 50 basis point reduction. This optimism is fueled by recent benign inflation data and even some encouraging words from Treasury Secretary Scott Bessent. The market impact? Lower borrowing costs typically make investors feel all warm and fuzzy, stimulating economic activity and potentially boosting corporate profits. It's a classic risk-on environment, pushing equity prices higher and bond yields lower, as everyone scrambles for riskier assets. And the party continues, according to another Bloomberg headline. U.S. stocks extend record run as risk-on rally continues. The S&P 500 is hitting new highs, riding this wave of risk-on sentiment. It's a perfect storm of expected Fed rate cuts, easing global trade tensions for now, and a surprisingly strong U.S. earnings season. What does this mean? It signals robust investor confidence. Everyone feels good about the economy and corporate performance, leading to elevated market valuations. While momentum can certainly carry us higher, it also inevitably sparks conversations about whether things are getting a little too pricey and if these rapid gains are sustainable. Finally, let's shift gears to corporate strategy with this one from Bloomberg. Apple plots expansion into AI robots, home security, and smart displays. Apple, the tech behemoth, is reportedly planning a massive push into new product categories. We're talking AI-powered robots, home security systems, and smart displays, all part of a grander plan to reassert its leadership in artificial intelligence. A tabletop robot companion could be here by 2027, with a smart speaker featuring a display possibly as early as next year. For Apple, this is a huge strategic move that could unlock significant new revenue streams and expand its ecosystem beyond iPhones and MacBooks, potentially boosting its stock performance. But it also means intensifying competition in the burgeoning smart home and robotics markets, which could shake up some existing players. Now, let's take a peek at a look ahead at the economic calendar. Keep your eyes peeled for the weekly jobless claims data, both initial and continuing, and the 4-week average. These are crucial because they give us a real-time pulse on the labor market. Remember how important that resilient labor market is to the soft landing narrative? Any significant deviation here could really get investors twitchy. Then we have a whole slew of producer price index data. Why does this matter? Because PPI often gives us a preview of what consumer inflation, CPI, might do down the line. If producer prices are heating up, it might signal that disinflation isn't as smooth as we'd like, potentially making the Fed think twice about those cuts. Oh, and keep an ear out for any speeches from Fed officials like Fed Barkin. They love to drop hints about future policy, and sometimes those hints are more like sledgehammers. So, there you have it. I'm Dave, and this is not financial advice. We'll see you next time.